First withdrawal from your defined contribution pension. Get it right and you can be set up nicely for the rest of your retirement. Get it wrong and you might have some regrets in the future, either around the taxes you might have to pay or maybe even running out of money. In this video, I'm going to explain the various options open to you. When considering your first pension withdrawal, the decision criteria should be whether you have a large pension that you're keen to withdraw from, or maybe just a smaller one, the other assets that you have, for example, a rental property, ISAs, defined benefit pensions, general investment account, and then also your expenditure needs. When defined contribution pensions weren't subject to inheritance tax, a common first withdrawal will be to take the full personal allowance of £12,570. Then under UF Plus, you could take tax-free cash of £4,190. But if you had some income that was reducing your personal allowance, you just adjust the withdrawal to allow for that. So you're not paying any income tax and you're using other assets such as a general investment account or an ISA to fund the rest of your expenditure. One thing that I do is I keep a track of all my income in a tax calculator spreadsheet. So if I'm earning some self-employment income or rental property income, I can then adjust what I might take from a defined contribution pension so that I stay within the personal allowance. Then I also take into account interest and dividend payments as well. And I'll put a link in the description as to how you can get hold of a copy of this spreadsheet. The drawback to this might be that if you had a large pension, then it could potentially be growing quite strongly, and you might find in later years that the only way to run down the balance effectively would be to pay 40% marginal income tax on some of that pension. So it's an okay strategy providing it fits in with the rest of your retirement plans, and you really need to forecast a glide path for your wealth prior to taking an initial pension withdrawal, just to check that the strategy is consistent throughout your remaining lifetime. You might want the first withdrawal to be just tax-free cash under Flexi Access Drawdown. And one reason to do this might be that you've got like a mortgage to pay off, or another reason might be that you want to kind of take a sabbatical and you might go back to work at some later stage. And if you only access tax-free cash from your defined contribution pension, then you can still contribute the maximum £60,000 if you have the earnings in later life. If you take taxable cash, then the money purchase annual allowance drops down to £10,000, which may or may not prove to be a problem. But remember that you don't have to take all of your tax-free cash in one go. You can take it in stages, and that's why it's called Flexi Access Drawdown. But you will need to check with your pension platform that they are able to facilitate this. Most of them can if they're the larger, more popular platforms such as Interactive Investor. This strategy works well if you have a large pension that exceeds £1,073,100, in which case you will have maxed out on your tax-free cash anyway, so you'll want to maybe take some out of the pension and either spend it or put it into an ISA. Another option would be to take tax-free cash and use that to build a bond ladder, and there's various websites that can help you to do this. You buy UK government bonds known as gilts, and you select gilts with different maturities, and then that de-risks your initial cash flows in retirement, and you've got a risk-off asset to go alongside your risk-on equities. And the amount that you would ultimately transfer would depend on the size of your pension and your income and expenditure requirements in retirement. Low yield gilts such as TN28 pay very little interest, so you probably won't pay any tax on that, and they're also exempt from capital gains tax. So even if it's held in just a general investment account, it's likely to be reasonably tax efficient. Another way to access your pension would be to take the maximum of the 20% income tax band. That would be £50,270 less any other income you might have. You then have the associated tax-free cash, which could be up to £16,757. Now, you don't have to spend all that money. You could move some into your ISA, your partner's ISA, or a children's ISA. But the idea would be to migrate money from your pension and to kind of lock in the 20% tax in case tax rates changed in the future, or in case maybe the available tax-free cash also changed. Two different withdrawal examples. The first one, we've got £10,000. We put the money into an ISA, pay tax at 20%, £2,000. That capital then doubles over the next 10 years, just to keep the numbers simple. And in 10 years' time, we've got £16,000 tax-free in our ISA. Now, if instead we have £10,000, keep it in the pension, it doubles over the next 10 years. We've now got £20,000 that we take from our pension. We're going to pay tax at 20%, £4,000, and we've got the same £16,000, irrespective of whether we move the money into an ISA now or whether we just leave it in a pension until we want to spend it. So one advantage of this strategy is that you're locking in to the current tax regime and you're not at risk of any new tax rates coming along and being disadvantageous to you. For your first pension withdrawal, you could take the whole amount that you want in that tax year in one go. However, if you do so, you're likely to be overtaxed by HMRC, as they're going to assume you're going to want to take that amount every single month for the rest of the tax year. So you'll probably need to fill in a form P55 to claim back any overpaid tax on a pension withdrawal. If this seems a bit confusing and complicated, you could speak to PensionWise, which is a free government service, and so long as you have the right questions prepared in advance, they should be able to help you out. So with our pension withdrawal strategy, we're looking to avoid spikes in expenditure, pushing us into the 40% marginal income tax rate, possibly because we've run out of tax-free cash too early. And we're also looking to avoid paying 40% tax in our later years, possibly because we've either only got pension assets left or we're trying to run down those pension assets quite aggressively because of inheritance tax considerations. So as a summary, if you have a small pension, you have to consider whether you have enough money to utilise your personal allowance until the state pension kicks in, and if not, you might want to top up that pension or retire a bit later. A medium pension, you can probably just take that as required and really focus more on not running out of money. A large pension, over 800,000 maybe, you can take up to the maximum 20% tax band and move money into an ISA if necessary, because you don't really want to spend it all because you could risk running out of money. And then for a very large pension where you've already maxed out the tax-free cash, you want to use Flexi Access Drawdown to accelerate that tax-free cash and either spend it, put it in ISAs, or construct a bond ladder. All of these strategies and more can be modelled in a retirement calculator spreadsheet, and I'll put a link to mine in the description. It's a very useful tool for giving you confidence around your finances in retirement.